Well, let's go to some domestic economics. Now, Australia's unemployment rate has increased in January to 5.3%, which came as a surprise for economists.
Does this mean a rate cut for the RBA might be closer than first thought? For more, business reporter Edward Boyd spoke to Westpac chief economist Bill Evans, who was fresh off a plane from the United States.
Bill Evans, thank you for joining us. You just got back from the United States. What's the vibe like there at the moment with the looming election?
Oh, Ed, look, there's a lot of factors that markets are taking into account at the moment. Clearly the election is one of them, and I think as Bernie Sanders seems to be rising in the polls, that gives the markets more confidence that there won't be a change of leader, and of course they see the current president as being more conducive to market stability than the sort of changes that Bernie would impose. A more moderate Democrat leader might well indeed create more uncertainty in the markets. Obviously the other issue is around the coronavirus, and people don't really understand the full implication for that. Federal Reserve still watching and waiting, but the share market seems to be pretty resilient to that.
So the markets are pricing in President Trump as the preferred candidate?
I think that's probably certainly most of the people that I spoke to expect that to be the result. Clearly the unknown factor is Bloomberg. He's participating in a debate this week. His name isn't on the Nevada list, but certainly people feel that that would be an interesting option. But at this stage anyway, Bernie is the front runner, and the market feels that Trump would handle Bernie pretty comfortably.
Turning to Australia, what's your read on the Australian economy at the moment with the threat of the coronavirus?
Look, it's going to provide a big shock to growth in the first quarter, mainly through the export of services channel. They represent about 3.5% of GDP. China represents about a third of that. So if the whole thing was to close down for a year, then we'd lose 1% of GDP. Now, we're not expecting that to be the case, but we are expecting that in the first quarter of this year that GDP will be flat, zero growth, rather than the 0.4% that we expected before. And that, of course, is probably on the most optimistic assumption that things will be back to normal in China from, say, mid-March onwards. And as the days go by, we start to feel that risk is rising, and therefore our forecast definitely has downside risk to it.
So 0% growth for the March quarter. What about looking ahead to June? Where are you seeing that?
For the year, we'd be looking at growth of 1.9%, which is well below trend of 2.7%. The June quarter will see a bit of a bounce back. So whereas you've got 0 in the first quarter, we'd be looking for 0.8 in the second quarter. So a total of annualised pace of 1.6 in the first half of the year, lifting to a bit over 2% in the second half.
The Australian share market hit a record high today. Are Aussie stocks overvalued?
Well, I think what we need to bear in mind is a very low long-term bond rate. And when we look at PEs relative to that bond rate that's sticking around that 1% level, the market doesn't look to be particularly overvalued. Heading back to my commentary in the US, it was very clear to me that the Federal Reserve has no intention of raising interest rates. They've talked about their inflation target being a symmetrical target around 2%. So in other words, if inflation, their preferred measure of inflation currently running at 1.6%, even if it spent a fair bit of time above 2%, the Fed wouldn't see any need to raise rates. So that more or less tells us that these long-term bond rates can hold at these levels for some time, and that is absolutely helping valuations in share markets, both in Australia and the US.
What's your reaction to the unemployment numbers today, which showed the jobless rate rose to 5.3%?
Oh, look, these monthly movements in the jobs numbers are quite frustrating, and our view is that the unemployment rate this year will be average around 5.4%. Whereas last year jobs growth was running at around 2%, we think this year it'll be more like around 1.1%. That's more in line with GDP. See, last year with GDP running at 2 and jobs growth running at 2, that's a zero productivity story. That's unsustainable. We think productivity is doing better than that, although it's not exciting. So this year with GDP once again running around 2, jobs growth in the low ones looks about right. But the population workforce growth, particularly with this ongoing lift in participation, particularly amongst females, is likely to see the labour force growing by more than 1.5%. So that means that there'll be some upward pressure on the unemployment rate.
After the data was released, the Aussie dollar fell to its lowest level since 2009. Is that a concern for the economy?
Oh, look, quite frankly, given what's happening in the Asian region with the coronavirus, markets would look at a country like Australia and say, well, who's got a highly liquid instrument, Aussie dollar? Which countries are going to be adversely affected by the slowdown in China, Australia? So I think the Aussie dollar's held up pretty well given the circumstances, and a lot of that is due to the change in signalling from the Reserve Bank. Whereas last year the attitude was very much, we think we should be able to get the unemployment rate back down to 4.5% or lower. This year it's more about, well, unless the unemployment rate rises markedly, then they're going to keep rates on hold. And I think the factor there is this concern about this state of the housing market. So with the markets being less aggressive on Reserve Bank policy, that's holding up the Aussie dollar even in the face of the coronavirus risks.
Do today's jobs numbers change your views on when the RBA may cut interest rates again this year?
Look, we've had April as the next move for some time. That may be a little early in terms of the RBA's thinking, but we certainly want to maintain the signal that interest rates are likely to be falling as we go through the course of this year. The Reserve Bank will be, if they're not achieving their inflation and inflation objectives, and we suspect they won't be, if they're in that situation and they want to target house prices along with these other factors, they'll just run out of instruments, and I think they'll probably have to use another instrument to address the housing issue if it becomes a big deal, and therefore they can use interest rates to address their key objectives around inflation and unemployment.
Is the Reserve Bank being a bit too optimistic with its targets for the economic growth in the economy?
Well, 2.75% is a good 0.75% above our forecast. We feel that they're optimistic right across the board in terms of consumer spending, business investment, dwelling investment. So yes, we do believe that their growth forecasts are too optimistic, and that of course will be another factor behind the eventual need for them to cut rates again.
The wage price index came out yesterday showing annual wages grew at just 2.2%. Are you predicting the wages to continue to fall?
Oh no, I think that's low enough, but it's a very, very worrying number because it's indicating household income growth will remain quite constrained. And with the savings rate as low as it is now, the boost to consumption that you would need when you've got such weak income growth looks unlikely. And of course, consumption is the key to lifting the economy. So with this weak income growth, it really is putting a dampener on the outlook for consumer spending.
Bill Evans, thank you for joining us.
Thank you very much.